So as we resume onto part 2 of this chapter, let's look at another question. Which of the following is an exclusive right to manufacture a product or to use a process? Is it a trademark, a patent, a copyright, or goodwill? Patent is the term for the right to manufacture a product or use a process. This right is granted for a period of 20 years. Let's now describe the accounting treatment of expenditures after the acquisition of an intangible. So, not of just an intangible, of an asset. Now, over the life of long-term assets, the owners often incur additional expenditures for repairs and maintenance, additions, improvements, or litigation costs. We capitalize an expenditure as an asset if it increases future benefits, but we expense an expenditure if it benefits only the current period. This slide is going to provide a summary of expenditures after acquisition. Repairs and maintenance is the cost of an engine tune-up or the repair of an engine part for a delivery truck, allows the truck to continue its productive activity. We expense repairs and maintenance expenditures like these in the period incurred because they maintain a given level of benefits. We capitalize capitalizes assets more extensive repairs that increase the future benefits of the delivery truck, such as a new transmission or an engine overhaul. Additions occur when we add a new major component to an existing asset. We should capitalize the cost of additions if they increase rather than maintain the future benefits from the expenditure. Now, with improvements, that is the cost of replacing a major component of an asset. The replacement can be a new component with the same characteristics as the old component, or a new component with enhanced operating capabilities. The cost of the improvements usually increases future benefits, and we should capitalize it to the equipment account. Last, legal defense of intangible assets. If the firm successfully defends an intangible right, it should be capitalized. However, if the defense of an intangible right is unsuccessful, then the firm should expense the litigation costs as incurred, because those type of costs don't provide any type of future benefit for the firm. So a key point to remember is we capitalize the asset, which means we record those items as an asset expenditures that benefit future periods, but we only expense those items when it benefits only the current period. So here's a question for you. Which of the following costs should be expensed? A, adding a refrigeration unit to a delivery truck. B, adding a new suspension system to a delivery truck that will allow for heavier loads. C, adding a new transmission to a delivery truck that will increase its life and future benefits. Or D, performing a tune-up on a delivery truck. Which of these would be expensed? Well, which only helps the current period? The tune-up. The cost of the tune-up is expensed. All the others benefit future periods and should be capitalized. Let's now look at cost allocation. We're going to talk about calculating the depreciation of property, plant, and equipment. Now, the dictionary definition of depreciation is a decrease in value or selling price of an asset, but the accounting definition is an allocation of an asset's cost to an expense over a period of time. Depreciation in accounting is allocating the cost of an asset to an expense over its service life. So an asset provides benefits or revenues to a company in future periods. Now we allocate a portion of the asset's cost to depreciation expense in each year the asset provides a benefit. If the asset will provide benefits to a company for 4 years, for example, then we allocate a portion of the asset's cost to depreciation in each year for 4 years. The illustration here portrays this concept of depreciating an asset's original purchase cost over the periods that get benefited. So let's do an illustration here. On this slide, let's assume the local Starbucks pays $1,200 for equipment, say an espresso machine. The machine is expected to have a service life of 4 years. So we record annual depreciation here of $300, which would be the $1,200 divided by 4 years. So the credit side of the entry requires some explanation here. Accumulated depreciation is what we call a contra asset account, meaning that it reduces an asset account. So rather than credit the account equipment directly, we instead credit its contra account, which we offset against the equipment account in the balance sheet. In this manner, a company can keep track of the amount originally paid for the equipment and the amount of depreciation that has been taken on the asset so far. Now, the book value is also referred to as the carrying value, which equals the original cost of the asset minus the current balance in accumulated depreciation. Note that by increasing accumulated depreciation each period, we're reducing the book value of the equipment. Each year the accumulated depreciation account increases by $300. The book value decreases by $300 because that book value is going to be the net of the original cost minus all of the accumulated depreciation. A common mistake that happens is oftentimes students mistake accounting depreciation as recording the decrease in value of an asset. Depreciation in accounting is not a valuation process. Depreciation in accounting is an allocation of an asset's cost to expense over time. Now, some students want to depreciate land, but land is never depreciated since its service life never ends. There are 3 primary methods of depreciation. First, the straight line is a method that simply takes the equal amount of depreciation each year. It's by far the most common method used in financial accounting. The declining balance method is an accelerated method, meaning more depreciation gets taken in early years than in the later years of an asset's life. The concept behind here is used in calculating depreciation for tax purposes. Then last, the activity-based method calculates depreciation over the use of the asset. It's used to allocate costs, oftentimes of natural resources. A key item to remember, depreciation refers to the allocation of the asset's original cost to an expense during the periods benefited. It doesn't refer to the change in the value or of the selling price. So let's look at straight line, which is the easiest understood and widely used depreciation method. With the straight line method, we allocate an equal amount of the depreciable cost to each year of the asset's service life. The depreciable cost represents the asset's cost minus its estimated residual value. Depreciable cost represents the total depreciation to be taken over the asset's useful life. To calculate depreciation expense for a given year, we simply divide the depreciable cost by the number of years in the asset's life, as shown on this slide. So if the asset's service life is 5 years, then we take the assets cost minus the residual, or can be called salvage value, divide that by its estimated life for a depreciable cost each year of $7,000 per year. This slide provides the depreciation schedule using the straight line method. So if a company bought an asset during the fiscal year, then the company will record depreciation for only the portion of the first year that it owned the asset. Now, what if a delivery truck was purchased during the year, say March 1st, and then was used for 5 years? What we would do is depreciate for the portion of the year that the asset was purchased. So in this case, if the asset was purchased in March, then we would take 10/12, which means 10 months out of 12 months it was utilized during the first year. So the first year, instead of being the entire $7,000, we would allocate 10 out of 12 months for the first year. Years 2, 3, 4, and 5 are given the full $7,000 a year, and then in the 2 months of year 6, we would take the remaining 2 months out of the 12 months. Let's look at another question. How much depreciation should be recorded in the first year for a delivery truck purchased on April 1st with a cost of $30,000, an expected life of 5 years, and an estimated residual value of $5,000, assuming the straight line method is used? So remember, on April 1st means that the truck would have been in use for 75% of the year, 9 months out of 12 months. So I'll give you some time to look at that. So if we look at the cost minus the residual value, $25,000 is what would be depreciated over 5 years' time, but again, we only want to take 75% of the first year. So the 30 minus 5,000, divide that by 5 years, would be 5,000 a year if it was the full year. But taking 9/12 of 5,000 would give us the $3,750. Depreciation is an estimate. Remember that the amount of depreciation allocated to each period is based on management's estimate of service life and of residual value, as well as the depreciation method chosen. So management sometimes periodically reviews these estimates, and if there's a change that's required, the company changes depreciation in the current and future years, but it doesn't go back into prior periods. So let's just say, for example, assume that after 3 years, Little King Sandwiches estimates the remaining service life of the delivery truck to be 4 more years, for a total service life of 7 years rather than the original 5. At this time, Little King also changes the estimated residual value to $3,000 from the original estimate of $5,000. How much should Little King record each year for the depreciation in years 4 to 7? Now we're going to take a book value take the book value at the end of year 3, which is $19,000, subtract the new estimated residual value of 3, and then divide that by the remaining service life of 4 more years. Now, Little King Sandwiches will record depreciation in years 4 to 7 as $4,000 per year. Now, as you see on this slide, notice that the Little King Sandwiches makes all the changes in years 4 through 7. It doesn't go back and change the calculations for the depreciation that we've already recorded during the first 3 years. Now this slide shows how depreciation is calculated under the double declining method. The double declining balance method is an accelerated depreciation method. Declining balance depreciation will be higher than straight line period in earlier years, but lower in later years. However, both declining balance and straight line are ultimately going to result in the same total depreciation over the asset's service life. The most common declining balance rate is 200%, which we refer to as the double declining balance method, since the rate is double the straight line rate. So as you see here, with the book value of $40,000, we calculate the double the rate, 40%. So 40,000 at 40% is $16,000. We subtract that amount to create a new book value of $24,000, and we will then take that book value of $24,000 times 40% to come up with our depreciation expense of $9,600. Again, we use that $9,600 to reduce our book value down to $14,400. And then year 3, we take the book value of $14,400 times 40%. Now, a common mistake is when using declining balance, mistakes are commonly made in the first and last year of the calculation. In the first year, it's often we calculate depreciation incorrectly as cost minus residual value times the depreciation rate. The correct way in the first year is to simply multiply cost times the depreciation rate. And then in the final year, some students incorrectly calculate depreciation expense in the same manner as in earlier years, multiplying book value by the depreciation rate. But in the declining balance method, depreciation expense in the final year is the amount necessary to reduce that book value down to the residual value. Let's look at a question here regarding declining balance, the double declining balance method. How much depreciation should be recorded for the first year for a delivery truck with a cost of $30,000, an expected life of 6 years, and an estimated residual value of $6,000? Assume the double declining balance method. So basically, we would normally under straight line take 1/6 per year, but under double declining, we're going to double it or take 2/6 each year. So the $30,000 cost we don't subtract for the residual value in year 1 times 33.33% would be $10,000 of depreciation expense for the first year of this asset. Now we'll look at activity-based depreciation. In this, we allocate an asset's cost based on its use. In straight line and declining balance, we measure depreciation based on time. We first compute the average depreciation rate per unit by dividing the depreciable cost the cost minus the residual value by the number of units expected to be produced. So in this slide, the depreciation rate ends up being 35 cents a mile. So we determine that by the cost of the truck minus its residual value. And if we estimate 100,000 miles, we take our 35,000, divide that by 100,000 expected miles to compute to 35 cents a mile. So to calculate the depreciation expense for the reporting period, we multiply the per unit rate by the number of units of activity each period. This slide shows a depreciation schedule using the activity-based method. The actual miles driven in years 1 to 5 were 30,000, 22,000, 15,000, 20,000, and 13,000. Note that the activity-based method is similar to the straight line method, except that rather than dividing the depreciable cost by the service life in years, we divide it by the service life in miles. We need to depreciate the asset until the book value, which would be the cost minus the accumulated depreciation, declines to the estimated residual value. Now this slide compares annual depreciation under the three methods that we've talked about. Comparing these methods, we see all alternatives result in total depreciation of 35,000. Straight line creates an equal amount of depreciation each year. Double declining balance creates more depreciation in earlier years and less depreciation in later years. And activity-based depreciation varies depending on the miles driven each year. This slide provides a graph that shows depreciation expense over time for each of these three methods. Companies are free to choose the depreciation method they believe best reflects the pattern of an asset's use and the revenues it creates. This slide shows the results of a recent survey of depreciation methods used by large public companies. Conflicting with the desire to report higher net income is the desire to also reduce taxes by reducing taxable income. So an accelerated method serves this objective by reducing taxable income more in the earlier years of an asset's life than does straight line. As a result, most companies use the straight line method for financial reporting, and the Internal Revenue Service's prescribed accelerated method called MACRS, Modified Accelerated Cost Recovery System, for income tax purposes. Here note that a key point, straight line, declining balance, and activity-based depreciation are all acceptable methods for financial reporting. Most companies use straight line depreciation for financial reporting and an accelerated method called MACRS for tax reporting. Here's an exercise we're going to look at. The donut shop acquired equipment for $19,000. The company uses straight line depreciation and estimates a residual value of $3,000 and a 4-year service life. At the end of the second year, the company estimates that the equipment will be used for 4 additional years, for a total service life of 6 years rather than the original 4. At the same time, the company also changed the estimated residual value to $1,200 from the original estimate of $3,000. Calculate how much the donut shop would record each year for depreciation in years 3 through 6. So basically, going back to here, how much would the donut shop record each year for depreciation in years 3 through 6? Well, the cost of the equipment minus the salvage value, divide that by 4 years, would be $4,000 per year. So for the first 2 years, we would have taken $8,000 in depreciation. So the book value at the end of year 2 would be the $19,000 minus the $8,000, which would give us $11,000 of book value. Now, if they now have a new residual value or salvage value of $1,200, our new depreciable cost would be the $11,000 minus the $1,200, which gives us the $9,800. Divide that by 4 years of remaining service life. So then in years 3, 4, 5, and 6, we would take $2,450 each year for the next 4 years to come down to our residual value. Let's now calculate the amortization of intangible assets. Now, allocating the cost of property, plant, and equipment to expense is called depreciation. Likewise, allocating the cost of intangible assets to expense is called amortization. Most tangible assets have a finite useful life that we can estimate. The service life of an intangible asset usually is limited by a legal, a regulatory, or a contractual provision. Most companies use straight-line amortization for intangibles. Also, many companies credit amortization to the intangible asset account itself rather than to use an accumulated amortization contra account. They just credit it straight to the asset. Here's an example. In early January, Little King Sandwiches acquires franchise rights from University Hero for $800,000. The franchise agreement is for a period of 20 years. In addition, Little King purchases a patent for a meat slicing process for $72,000. The original legal life of the patent was 20 years, and there's 12 years remaining. However, due to expected technological obsolescence, the company estimates that the useful life of the patent is only going to be 8 more years. Little King uses straight-line amortization for all intangible assets. So Little King is going to record the amortization expense by $40,000 each year, which is basically the $800,000 divided by 20 years. Now, as we move on, let's look at another example. In early January, Little King acquires franchise rights from Hero for $800,000. The meat slicing process of $72,000. It was an original patent of 20 with 12 years remaining, but due to obsolescence, we think there's 8 years left. So in that case, we're going to take the $72,000 and divide it by 8 years for the patent for that meat slicing device. We don't depreciate land because it has an unlimited life. Also, we do not amortize intangible assets with indefinite useful lives that may not be determinable or that are unknown. So this slide provides a summary of intangible assets that are amortized and those that are not amortized. Management must review long-term assets for a potential write-down when events or changes in circumstances indicate the asset's recoverable amount is less than its recorded amount in accounting records. The recoverable amount is the cash expected to be received from using the asset over its remaining useful life. All long-term assets are subject to these impairment rules. A key point to remember: amortization is a process. It's similar to depreciation, where we allocate the cost of the intangible asset's life over its estimated service lives. Intangible assets with an indefinite useful life are not amortized. Now, oftentimes, goodwill and most trademarks will not be amortized. So to end this portion of the lecture, let's do another question. Which of the following intangible assets would not be subject to amortization? Trademarks. We don't amortize intangible assets with indefinite lives. So if a trademark has an indefinite life, we wouldn't amortize it.